Good morning, traders. Let's walk through today's market. So, starting with the US dollar index, the dollar fell for the fourth straight session on Wednesday, touching 97.46 at one point. This week has followed a familiar pattern, opening high, then fading and moving sideways. The backdrop is the first US government shutdown since 2019 after Democrats and Republicans failed to reach a temporary funding deal. Above 750,000 federal employees could be furloughed, costing an estimated $400 million a day. And crucially, Friday's non-farm payrolls report could be delayed. That leaves the traders relying more heavily on the ADP jobs data later this week. And from a technical view, the index has slid from a recent high of 98.6 and now trades below the Bollinger midline at 97.9, but above the support near 97.2. And indicators show weak consolidation, with upside capped by resistance at 98 and 98.49. If the index breaks 97.2, it could quickly slip to 97. Moving to WTI crude oil. The price has slipped again in early European section and testing $61.7 per barrel. The prices were pressured by headlines around OPEC. The group denied reports of a 500,000 barrel per day production hike for November, easing some supply concerns. And meanwhile, flows through the Iraq-Turkey pipeline resumed after more than 2 years, adding fresh barrels back to the market. The tug of war between supply disruptions from Ukraine's drone strikes and the weak demand expectations continue to keep oil range bound. And technically, prices have been stuck between 61.5 and 65.5 since early August. Bulls have failed to clear resistance near 65.5, which aligns with the 168-day moving average. And on the downside, support remains firm at 61.45 and 61. And for now, the trend is sideways, with the 50-day average at 64.11 acting as a resistance. And next, gold. Gold surged again on Wednesday, hitting a fresh record at $38.95 an ounce, edging towards the key at 3,900 mark. The metal has already risen more than 45% this year, with September alone delivering a double-digit gains, a rare move by historical standards. And geopolitical risks in Europe and the Middle East, coupled with the US shutdown crisis, have kept the safe haven demand strong. And technically, gold has stabilized above the 3,800 level, a key psychological and moving average support. As long as that area holds, the bias remains constructive. A resistance stands at 3895 and 3900, with the scope to extend towards 3950 if momentum builds. A break under 3800, however, would shift the focus back towards 3750 and 3700 consolidation zone. Last but not least, the Australian dollar. The Aussie dollar hovered just above 66 cents on Wednesday after mixed domestic data. Australia's AIG index improved but stayed in contraction, while PMI data slipped from August levels. Meanwhile, building approvals fell more than expected. On the US side, the shutdown concerns and soft labor data are limiting the downside pressure on the Aussie. And on the charts, Australian dollar is trading inside an ascending channel, with RSI just above 50 suggesting a mild bullish bias. Upside targets include last month's high at 67 cents round number. Support sits at the 50-day moving average around 65.42, and a break there could expose the August low near 64.14. So that concludes today's morning review. I keep an eye on the US jobs data, shutdown developments, and OPEC headlines. They will be key drivers this week. So trade safe, and I will see you in the next update.